All right. Well, good morning and good afternoon, depending on which coast you are on. Hi, I'm Rod Schulhauser, our Director of Marketing here at Rock Advisors. And we're excited about this webinar. We've got some great speakers from out west, and we got some of us from the Ontario region as well. But before we kick things into the content and get you started with everything, we just want to make you aware of some things coming up. Of course, we may even hear about this today a little bit. With the federal budget, we are going to have a strategy session next week. You can see it right here that if you want to chime in and take in our advice and some expert advice, we've assembled some team. Michelle Duran, we got Laura Gurr on as well with Fran and Derek. And we are going to be talking strategies relative to apartment development as it relates to that budget. And later on in May, we're going to talk about the opportunities to restructure new apartment construction financing. This is the second in a series of webinars we've been doing on this topic. And lastly, we'll just talk about the year-end event because I know a lot of you attend the Toronto Real Estate Forum, and we will have that dedicated apartment development and affordable housing session available. And you can scan the QR codes to get more details as we move closer to those events. Now, for today's webinar, we do have the chat box open, and I encourage you to make use of those. And if you've got questions on the fly, go ahead and just put them in there, and our speakers will pay attention. Sometimes they'll type out the answers, sometimes we'll address them live, but your interaction is encouraged. And for those of you that are going to look for a recording of this, maybe you've got colleagues that aren't joining us live, we will be putting this on the landing page. There's a follow-up email that will go out to direct you to that recording, and it will be at your disposal. Now today, here's our agenda. We've got an introduction to Alberta that Derek will kick into here in a minute, and then we've got a focus. We've actually got Matthew Sheldrake from the City of Calgary talking about the focus that they have. And then we have Jeremy Tomlin Reeves talking about the forces that are driving Alberta real estate. And then we'll bring our other speakers in on our panel, which will feature Brian Stoddard and Harvey Russell along with Derek Lobo. So just to kick things off, Derek, I'm going to turn things on over to you as you just kind of get us going with a little bit of introduction.
Okay, so great. Thanks. So, I was just in Alberta yesterday, and I spent 3 or 4 days there. And I don't know what it is. I always feel this in Alberta is I feel more activity, more hope, and just generally more energy about the economy. And, we living here in Central Ontario in Central Canada have maybe a little bit more of a damper on our lives. And I don't know what it is, but we think that the Alberta market is something that we should talk about more in Canada as a place to invest. So we like to show you here today. Lots of friends are here. AJ, Phil, Arnie, good to see you here, man. Okay, so Harvey's going to join us later. We've got a 20, 30-year relationship with Harvey, and what often happens is a lot of the buyer pool is in Central Canada, right? And the product to buy is in Alberta. And so what we've done is we've just teamed up with Harvey over the years. We've done a number of deals together. I think in the last 18 months or so, we've sold 2 deals in Alberta with Harvey. And it makes sense. They're new apartment construction. That's kind of our expertise. And so we've done that. We've also got another property here that we want to talk about. And Brian Stoddard, the developer of the Spray Group, is here, the Glamorgan. And then we're going to talk specifically about, how this marketplace is going. I mean, building buildings is a challenge everywhere. Building buildings for the last 2 years has been a supreme challenge. But in Alberta, it still seems to be working, even with all the problems. We want to talk about that. And so we're going to talk about new apartment construction in Alberta today and why we think that it's a strong market. Okay, slide. I think everybody knows this, but it's just worth pointing out that Alberta GDP is strong. And it's certainly stronger compared to Ontario and the rest of the Canadian markets. Yeah. So people have money in their pocket, right? And part of the reason is, and this is going to be brought by other speakers, but from an apartment standpoint, apartment demand, apartment rent is driven by really 3 things. Population growth, income, and to some extent age. Okay, because younger people tend to rent, older people tend to rent. Families tend to be able to afford homes and so on. So population growth is a big thing when you're looking at apartment demand and pipeline in the future. And certainly Alberta is very strong. That's also internal immigration. They probably tend to be wealthier, maybe have more money in their pocket when they first come there. Yeah. All right, next. So, okay, well, we'll go. Okay, Matthew. We got a presentation from Matthew Sheldrake, the from the city of Calgary.
Hi, everybody. As Derek mentioned, my name is Matthew Sheldrake. I am the manager of growth and change strategy here at the city. And so that involves a couple of things that would touch on the rental market. Obviously, housing growth, employment growth. These are all drivers that our rental market is responsive to and responds to. I'm going to be pretty high level in my comments today, but I will have a few numbers and a few quotes that I think will get the discussion going, and I'd be happy to answer any questions that you have. In terms of the department that I represent, Planning and Development Services, it's a quite a large department as far as planning departments go in Canada and in North America. It really covers everything from soup to nuts in the planning process, everything from long range municipal general plans right down to occupancy permits and safety codes and things like that. The part of the game that I spend most of my time in is around long-term planning, growth infrastructure investments, priority growth areas, policies that obviously are pro-growth, but are also pro-sustainable development, um, pro-socioeconomic, and other demographic and equity related policies as well. And so there's a lot going on in Calgary. It's a very busy time in Calgary, and our department is certainly no exception. Next slide. The business unit that I am a part of, City and Regional Planning, covers everything that you see on the map there. And the ones that I think are probably most pertinent to this group here today are our work in new communities, which is around approvals as well as infrastructure investments, established areas growth, which is around investments to increase capacity for additional growth in established areas, as well as policy that enables that. The demographic and the spatial analytics, we are a very data-driven department out here. We rely heavily on everything from census data to building permits, and that drives a lot of our decisions. It helps to cut through some of the the times that we live in when there's conflicting opinions on this and that. That we go back to the data quite frequently to get us through that. And then housing. I mean, I think this is a national question, but housing is white hot right now. We saw that in the federal budget yesterday. The city recently approved a housing strategy with just some incredible targets for new units. Like never before, I think the focus is on cutting red tape, getting investments out there, getting people in homes to help deal with both an affordability crisis and then just an overall a lack of supply, both at the non-market and the market levels. Next slide. So 3 things I'm going to talk about today. First, I'm going to talk a little bit about that growth momentum in Calgary, what that looks like, what the numbers are telling us. I'm going to talk about what the development trends have been in response to that growth that we're currently seeing. And then as well as what are we doing at the city of Calgary to facilitate and accommodate the growth that we're seeing. So you may have heard that Alberta experienced a growth of over 200,000 people in 2023, largely driven by international migration. And Alberta is, as many of you will probably know, Alberta is used to booms and busts, typically tied to the price of oil and other commodities. And you can see that reflected in the graph on the left-hand side there, my left. You can see the growth in the 1970s, followed by the dips in the 80s, and then a series of booms and troughs through the 2000s before it extended trough, and then what we've seen recently. And what we've seen recently dwarfs everything that we've seen before. And it's also different because it's not singularly a resource-based boom. It's largely being driven by massive amounts of international migration, significant amounts of interprovincial migration that are taking advantage of, well, a year and a half ago, I would have said significantly lower housing and property prices in Alberta, but that is changing. That gap is narrowing. Calgary typically takes about a third of the Alberta market in terms of growth, and anywhere between 40 and 60,000 people per year just to the city of Calgary. And for a city of only 1.4 million, that's quite a jump, year by year by year. And so we are breaking population records. We are breaking housing start records. The census metropolitan area saw almost 20,000 housing starts last year. We typically see around 10,000 is our rule of thumb. But it hasn't been enough to keep up with demand. It's been crazy, actually, to see interest rates go from 2 to 6% on mortgage rates and everything else, and to still see housing prices rise 10% in the city and rents rise 14%. Again, it is. I mean, the word unprecedented gets overused, but that's really what we're seeing. And you can see on the chart on the right that Calgary grows even in the bad years. It's a very steady growth. The growth actually itself isn't steady, but it is consistently a growing city. And I think that the city is better for it. It creates opportunities, it attracts investment, creates that climate that we're trying to get to keep that cycle going. Next slide. Two things that we're very proud of in Calgary. The Economist recently ranked us as the 7th most livable city in the entire world, the second most livable city in North America, just behind Vancouver. We were actually down a little bit. We were the 3rd most livable city a year ago, but being in the top 10 is something that you'll hear Calgarians talk about a lot, because it's a great source of pride. And in terms of our permitting and our planning department processes, the Canadian Home Builders Association ranked us 3rd in the country in a study that's comprehensively looks at processes, approvals, charges, all those things that can not only affect the business climate in terms of willingness to invest, but also housing affordability as well, if you get right down to costs that flow through to the end user. So even within this, like the last number I gave you, around 20,000, that was for the CMA. Even within just the city of Calgary, we built over 15,000 new homes last year. The residential construction value was 4.3 billion. This was the highest per capita rate among the large cities in the country. So about 12 new units were built for every 1,000 people, and you can see in the graph how that stacks up against the other cities in the country. 2024 has picked up right where 2023 left off. We're seeing numbers that are actually 40% above last year, which was a record. And the city of Calgary continues to do really well in our region, attracting about 85% of all of the metropolitan area housing starts occur within this city, and that's been consistent. We'd like to see that number where it is. If that number declines, it means that we're sort of seeing the satellite cities begin to take more of that share. Not that we're in a competition, but it's important to the city to be that central node as the economic and the housing engine for the region. Focusing now on the established areas, and again trying to take this back around to the apartment market and the rental market. This is where the majority of our apartments and our rental product is built, is within the established areas. And our apartments continue to dominate that category. You can see that that's the red bar on the bottom, taking anywhere from 2/3 to maybe 3/4 of all the starts, the new construction within the established areas. We're also seeing a lot of pickup in row house and townhouse options. This is sometimes called the missing middle. And these were typically always owner product or purchase product, but more and more in the last few years, they've become rental products where the developers or the eventual investor will hold on to them for a period. Rental has definitely increased. Calgary has typically been an owner town, at least over my career, the last 20 years. But that has changed within the past 7 or 8 years. There's been a lot more purpose-built rental in the city than there was during the first 15 years of my career. Even with that said, we're still seeing vacancy rates that are quite low. And in the past, declining from about 2.7 in 2022 to 1.4. And I've seen a lot of stuff written about that 3% vacancy rate. When that drops below 3%, things get a little wild. And so we have started to see, lineups for units when they come up for rent, even bidding wars on rental units. And so it would be great to get that number back above 3% and get to a little bit more of a balanced market and take off some of that pressure that we're seeing on affordability. In terms of what the response is, so the first thing I'll talk about is our citywide growth strategy. So this is a strategy that's very implementation focused. It's not just a policy on the shelf. It's really focused on investments, improvements, analytics, and awareness to increase growth across the city, not just in one area, but just across the city. As we looked at that, when I think about new communities, we've got 7 to 9 years of service land supply for new developers to tap into when they build new communities. And across the city, we had 45 different communities that built over 100 new homes in 2023. So it is a broad-based housing boom that we're seeing in the city. On the policy side, we're currently refreshing our municipal development plan, which is our general plan for the city, the zoning bylaw, and our street standards, in order to bring them into the current market, responsive to current trends, and also make those among the most progressive growth plans in the country. Next slide. We also recently approved a housing strategy, our council did. And this strategy compelled us to accommodate 1,000 more market and 3,000 more non-market units above what we normally even would have seen per year. And that's, we are hurting on the non-market side. Market is strong, but that non-market, that's a social issue, and it's something that needs to be addressed. Getting people into houses can help solve a lot of social problems, and we're working on that. That strategy had 98 actions that it compelled us to do as a municipality to try to increase supply across the spectrum. We are also part of the Housing Accelerator Fund, which I'm sure you're all aware of. Calgary received $228 million to help reduce barriers and increase investment in the housing stock to build, I think it's around 6,500 more units than we would have otherwise, as required by the federal Liberal plan there. So that's really it for me. I'm happy to take questions. I know I rolled through that pretty quickly. I hope you'll consider investing in Calgary. We need all the rental we can get, really. And so if you have any questions about the market, I'm sure my contact information will be available, and I'd be happy to talk to you. Thanks for your time today.
Thank you very much, Matthew. That's awesome. Great insight. And hot on the heels of Matthew's information, we got Jeremy Tomlin Reeves, who's a partner at Ignite Strategic. And we actually pre-recorded Jeremy just because he's on an airplane. So we had him put his information together for us yesterday. And so we've got it right here for you. And we will get that in motion.
Good afternoon. It's Jeremy Tomlin Reeves. Pleased to be with you here this afternoon. In this brief presentation, I just wanted to set the stage in terms of what's happening in the purpose-built rental market. First of all, looking at what's driving population growth, which is migration, setting that stage and putting some projections on a go-forward basis. And then sort of focusing on the Calgary advantage of affordability and real estate cost. And then looking a little bit more deeply into the urban core and what's happening in the supply and demand side through 2028. Looked at a sort of 6-year window. So we'll start off with the migration story. So on a historical basis, Calgary has attracted about 50% of all international interprovincial migration coming into the province. The numbers varied a little bit, but generally it's been in that 50% range. In our projections moving forward, we're taking a conservative approach, looking at the forward projections through 2028, and we've applied about a 45% to Calgary. And the numbers are profound. So last year, to set the stage, Alberta through 2022 Alberta attracted about 81,000 international interprovincial migrants, and that is moving toward about 200,000 this year, just shy of that. And if we apply that 45%, which will be verified shortly, that will mean that we'll see about 89,000 residents arriving in Calgary through 2023, or to put it another way, 244 individuals per day. This chart just shows the numbers you'll see in green, and those are the numbers that were tracking through Q3. So you can see on an interprovincial basis, there were 45,000. And on an international basis, the net number was 103,000. So we're totaling about 148 through the first 3 quarters, pushing toward 200 projection for year end. On an overall basis, we're the 4th most prolific province, and on a proportionate basis, it will be number 1 in terms of growth by population. So again, just looking at some of those numbers, the international arrivals were 103,000. This international specifically would include both permanent and non-permanent. So through Q3, 103,000, that's pushing toward about 140,000 through year end. And the other important factor to look at when we're looking at future growth is that approximately 10% of national migration is moving to Alberta, and that's been fairly consistent over the last 4 years. On an interprovincial basis, there were 45,000 through Q3, trending towards 60,000. And at 45% ratio, Calgary would see about 27,000 interprovincial migrants, of which 70% are originating from Ontario and BC, which is a fundamental change. Historically, we've seen most of that growth coming from the East Coast or Saskatchewan. So we are seeing a different breed of jobs that are attracting a new resident. So on a forward basis, we've built a model which is very different to what the city of Calgary is projecting in terms of overall population growth. So adding in natural population growth, we're seeing Calgary's population to increase by 96,500 through 23, which will be a 7.2% growth ratio. Or as we go forward, and we'll look at the next slide, we're seeing an average of about 4% growth per year through 2028. So just to illustrate that, in the first column there in yellow, 2023 at 45% share, we're seeing overall growth of 96,500, of which 7,500 will be through natural growth, and that's fairly consistent. It has been fairly consistent over the last few years. 62,000 through international growth and 27,000 through interprovincial. The big reason for that huge number this year is really the very high number of non-permanent residents. So on a planned basis, the federal government is planning to attract 500,000 into permanent residents and 300,000 non-permanent residents. That non-permanent number was up to about 875,000 this year for all the reasons we know in the world today. So really in 2025, which is really the key, we've assumed that we'll move back to a 300,000 non-permanent resident number coming into the nation. So putting that into the growth forward projection, we're expecting to see ongoing growth on a conservative basis into Calgary of about 50,000, of which about 7,500 will be natural, 36,000 through international growth, and 6,750 through interprovincial. We've cut the interprovincial from the high in 2023 at 27,000. We know the affordability advantage is still there, but it will start to ease off. The affordability advantage will ease off. So we've taken a conservative split drop by 50% into 2024 and a further 50% into 2025. So that 50,000 is very, very conservative. So what that means in terms of residential real estate demand is that with an average of 2.2 persons per household in the Calgary marketplace, we can expect in 2023 demand for 40,000 residences, which was not being met by the market, which is why we're seeing 0% vacancies, et cetera, et cetera. And on an ongoing basis, with growth of about 50,000, that's going to generate demand for about 22,000 to 23,000 residential units. We talk about the Calgary advantage and why migrants are gravitating towards Calgary. And one of the primary reasons for that is the income affordability index. To maybe move to the next slide here, Rod. So this looks at major cities, and we see across the top column the median incomes in Calgary, Vancouver, and Toronto all relatively close. Calgary is settled at 92,000. It's moved down from a high about 115,000 in 2015, and has been very consistent in that 90,000 range, which is really a testament to the new breed of jobs that are being created in Calgary, which is moving away from the energy sector into new industries. Tying that back into median house price, Calgary is at 540,000, Vancouver 1.2, and Toronto virtually 1.2 as well. So the typical or the median household is putting 43% of their income in Calgary toward real estate. In Vancouver, it's 99% plus, and in Toronto, it's about 87%. So the attraction of Calgary is this affordability that we still have today. The gap is closing, but it's still very significant. And so we're seeing this affordability translating into resale trends and also new construction. So on the resale basis, we've seen a shift in multifamily transactions move from 47% in 22 to 53% in 2023, of which the majority were for apartment condos. So we're seeing that push toward affordability. And on the new construction side, we're seeing a similar trend. We're seeing this shift to multifamily. It's moved from 63% in 2021 of all starts to 66% in 22 and 71% in 23. And when we look at those new starts, about 45% of rental starts have been occurring in the urban core. Next slide. So just drilling down into what's happening in the urban core itself. We're seeing a bit of an uptick in supply this year. We're going to see about 3,000 units, but it's going to drop sharply in 25, 26, and 27. And we'll get into the demand side shortly, but you'll see there's a huge chasm between supply and demand. And the challenge is that really everything that we know is happening is included in these numbers, and for any other projects to trigger and be deliverable by 26, 27 is going to be very, very difficult. So we are moving into a real window of shortage in supply. Next slide, please. So what this shows is there are really three conduits delivering rental property into the urban core. We have the new purpose-built rental sector, of which today there are only 340 available units. That's less than 2 months supply. So we have the rental conduit, we have the office to residential conversion, of which are 14 projects committed to be converted. And we have the new condo market, of which 90% of all new condo sales are to investors with rental guarantees, essentially fueling the rental market. So when we put all those together in 2024, we'll see just shy of 3,000 units being delivered, which will be fairly close to demand levels. So we'll see of that, there will be about 2,000 units that will be new purpose-built units, 567 conversion units, and 460 new built condos that will be owned by private investors. Those numbers drop dramatically in 25 to a total of just under 1,500, and then to 700 and 680 in 2027. So those numbers, when we look at that blended out, there'll be an average about 1,500 to 1,600 units per year on average being delivered, with very little ability to add to that in the short term. So what this shows, this is really looking at the expanded urban core. We're looking at the downtown and the Beltline districts, as well as the surrounding neighborhoods, which are really relevant in that the international migrant doesn't look at the boundaries of the downtown and Beltline core. They'll look at an expanded urban core. So, which in Calgary will be defined as wards 7 and 8. So when we look at what's happened over the last 7 years, from 2016 to 2022, there were the population grew by about 17,000 people, 2,450 people per year on average. going forward and applying our growth projections, our migration-based growth projections, what we see through the next 6 years through 2028 is the population will grow by about 47,000 or nearly 8,000 people per year, or an average of about 4%. We've got a very big year this year at 7.2%. When I say this year is 2023, the average will be about 4%. That population growth translates to just about 4,000 units of residential real estate as a need. So well beyond the supply engine. So big opportunity for new development. So just looking at what's happened on the net rent side, when we look at post 2016 or new product, the rental rates increased by about 15.5%. We're an average about $320 per square foot through 2023. And that's equal to what we saw through 2022 with a 15.8% increase. If we look at the overall rental market, so older inventory tied into that, the city of Calgary through 2023 saw about a 17.5% increase in average net rent. And the downtown core Beltline, when you blend that out, it would be about 21%. So we are seeing a more robust market in that urban core. Next slide. And this just illustrates really what's been happening since 2019 in average net rent. So you're seeing this prolific increase that has occurred since 2022, where we're seeing over a 30% increase per square foot. So look, moving forward, there are some things that are happening based on that. Affordability is becoming more critical. So we are seeing developers move to very compact one bedroom and sub one bedroom units for affordability, as the average single person has an affordability index of about $1,600 today in the urban core. And we are seeing a movement towards single sharing accommodation. So we're seeing a big uptick in rental rates for 2 and 3 bedroom units. So as a sort of conclusion, we are seeing Calgary, we're seeing the market opportunity remaining robust over the next 6 years and beyond. We are seeing particularly in the urban core, we are seeing a chasm between supply and demand. So developers that can act quickly would be in an advantageous position to deliver to a shortfall market through 26, 27, and 28. The other trend that is happening is Calgary is a very suburban market. So we are also seeing big growth of rental in the outer circle of Calgary. So the same trends that we're seeing in the urban core are also transposing into the larger Calgary environment. So lots happening in the market. And if there's any questions, you can reach me of the numbers provided.
All right, Derek. So we'll head on over to you, and we'll get things rolling.
Okay. So Rod, I'm here, and we've got Brian Stoddart with us. Brian is the president of the Spray Developments, and we want to talk now from a developer's perspective. Rod, I can just say all very, very interesting. Calgary and Alberta are not like the rest of Canada, right? And we've done this webinar on Alberta a few times now, and we kept saying that there was room for rental growth in Calgary, right? Because we just looked at the income versus the rent. You compared that to the rest of the country and the capacity to pay, and a 14% increase, I think, is pretty significant. And there's still room, right? And there's still room. Okay, Rod, let's go to the first slide. Brian, are you there? Are you unmiked?
I am.
Okay, great. Okay, so let's go off to the first slide, Rod, please.
Yep, everybody's here for you, Derek.
Is Harvey here?
Yes, he is.
Harvey, you got out of the rehab on time? Okay, great. Good to have you here, man. All right, okay. First slide. So, I work across North America, and I've worked in 9 provinces, about now 20 US states. And I look at North America and I just wonder to myself, okay, this has nothing to do with Alberta, but it's just me thinking out loud. If we were to redraw the map of North America based on cultural lines, okay, I think we would wind up with 5 or 6 different countries, not 50 states and 10 provinces. Now, each country can be broken up. But when you think about it, like if you think about, okay, let's take the people in British Columbia, Oregon, California, and so on. There's that kind of West Coast culture, right? Like when I do seminars there, they show up in shorts, right? Nobody in Ontario is ever going to come to a seminar in shorts. It's just, that's a simple thing that I'm saying. If you think about the people in the North, you know, people in Alaska probably have a lot more in common with people in Yukon, the Northwest Territories. And Alberta, when I come there, and I come there often, always feels like kind of the central part of America. You know what I mean? It's Texas, Oklahoma, South Dakota. And so I just sense that oftentimes when people invest, and we take money across Canada and we take money down to the US, right? People tend to invest and relate to people of a similar culture. And I'm going to argue that the culture is more north-south. Okay. And then when you move over, you've got sort of central Canada. I don't know, when coming from the Toronto area, living here most of my life, I feel very comfortable in Ohio and in Chicago and things like that. I think New York is special. It's just New York, right? And then when you think about, you know, the Maine and Nova Scotia and New Brunswick, you know, it's kind of like a maritime kind of thought. And then I think there's kind of like an East Coast kind of thinking. And then of course we've got Louisiana and Quebec, which have like a little French culture and so on. But just the thought that Alberta acts like the homeland. Okay, so this is the overall real estate cycle, and the point I'm making here is it's not the same everywhere in Canada. Okay, so I'm going to say that in Ontario, development in general, you can see where the arrow is in this part of the cycle. Okay, we're hoping this is kind of the bottom part of the cycle, right? There's a little bit of fear, a little panic, a little bit of despair, right? And this cycle repeats itself on a different wave. Brian, where would you say we are in this cycle in Alberta for apartment development? That's what I'm referring to. We're only talking about apartment development here.
Derek, I think we're obviously at the excitement level, but there's also apprehension there in terms of the ability to fill that need. Like we're struggling with trades, we're struggling with land.
Yes.
So there's some reservations there, but certainly I think as an industry, we're cautiously excited. We're not, you know, we're excited about the demand for sure. We're concerned about the ability to supply.
Yes. Yeah. Harvey, what are your thoughts on where we are in the cycle? Both Brian and Harvey is a commercial real estate broker. He's also a developer. And Harvey, what are your thoughts on where we are in the cycle?
Well, I agree with Brian. You know, we're 2 or 3 years and significant growth and significant amount of apartment development and whatnot. But, you know, one thing that, you know, I can look back over starting in 2016. So between 2016 and 2022, there was about 150 apartments built in Calgary and about 15,000 units. So we went through a time of 50,000 layoffs. We had our immigration went in half. We had COVID. We had all of that. And this significant amount of rental apartments was built during that period. And the vast majority of it did very well. And, you know, we had the advantage of growth here in the last little while. So I'd say all that product today is done really well. And so I just think that attribute to rental apartments and the stability of them. And, you know, that's quite remarkable in my view.
Yeah, no, you know, listen. We do this webinar because we think Alberta has energy. Alberta has legs. Alberta has motion, right? When we look at this thing without any bias, because we don't live in Alberta, right? We're seeing all the things that Harvey is seeing, and the data is telling us that. Okay, so Rod, maybe go full screen now and just talk, right? I don't think there's another slide till we go a little later on. When I talk to Ontario investors, and that's really what I hope to do in this webinar, is bring Ontario larger investors to Alberta. The thing that always comes up is volatility, right? Yes, no, but you know, Alberta is more volatile, therefore the cap rate should be higher. I'm bringing safe, stable money, and that's what apartments are. They're safe and they're stable, and they don't have volatility. I feel Alberta has volatility. How true is that? Harvey, I know you looked at rents in Alberta, because that's what you care about, right? It's stability of rents, stability of vacancies. What have rents done in Alberta over the last 20 years? Are they up and down like a yo-yo?
I just did this report and anybody could email me and I'll send it to you. So I talked about two things. I said, I've been beating the streets all over Canada, selling apartment buildings for 30 years. And I run up against a lot of skepticism about Alberta. And there was just a apprehension about Alberta. And, 9 guys out of 10 that I talked to, they didn't have enough confidence to come here. What I did here in this report is I talk about, obviously there's been volatility, but what I did is I put apartments on a chart for the last 23 years. And I found out that the growth, 7% compounded growth over 23 years. So basically the macro market, there's volatility of different sorts, but the apartment market performed.
But hold on, Harvey, was that 7% an up and down? So some years we had 15 and some years you had -5. So guys scared of buying the top of cycle, or are you saying it's relatively consistent?
I can send people my chart and
just tell us.
I know this. So 2000 to 2008, it was like that. And then we had a little dip. And then we another significant thing. Over 23 years, we had 15 years of growth. We had 5 years of kind of flat or maybe a little growth. There's only 2 years where we had negative.
Okay, so what's happening is everybody's remembering that 2 years of negative growth, right? But what you're saying is if you look at it over the long term, it's pretty good. Okay. I want to talk about another kind of volatility, and that is political volatility, right? So everybody watched the budget yesterday. Not good news if you're in the real estate business, right? The capital gains exemption, which was 50%, right? Now it's gone up to 67%. So basically, I think it means if you were paying tax on $100 million gain, you may have been paying $27.5 million if you left it inside your corporation, right? I think that number now jumps up to almost probably 36 or 37 million. Brian, as a developer, comment on what that means to you, that volatility, and federally anyways.
Yeah, what it means to me is I'll wait until after the next election before I sell any properties. It's definitely a concern. That's a 30% increase in tax. The first time in 20 some years that we've adjusted with the capital gains inclusion rate. And if you remember over the years, it was 50%, went to 2/3, went to 75, and moved back and forth. And everyone talks about capital gains and they forget the reason why the inclusion rate.
Perfect. I wanted it. Yes, maybe everybody,
because there was no such thing as capital gains prior to 1971. So on January 171, we had a valuation day. Every capital property was valued at that day. The reason we only include 50% of capital gains into our income was to recognize the fact that many of these properties or assets are held over many years, and a lot of that gain is nothing more but inflationary gain. And that's the reason that capital gains are only partially taxed or not fully taxed in the first place. And we forget that. Basically, that foundation of capital gains, we forget that the whole purpose of that was to back out inflationary gains so we're not paying tax on imaginary gains.
Brian, I thought the reason for the capital gain is just to reward investors for taking risk. You took more risk, so therefore you should get a bigger piece of the pie versus the person who took no risk. That's why interest rates, if you get a 4% interest rate, it's 50% taxable, right? It's taxable at the full rate. But yet if you get a capital gain, in theory, you paid less because you took more risk, and we need people to take more risk for the country. Is it both, or is it you're an accountant? You used to be in that.
It's both. And I was previous life, I was a tax partner. So, but originally the concept was that it was to recognize that a lot of the gains that we have is inflationary. So if you sold a property that you've held for 20 years and then bought an identical property, you didn't have a gain. You were just replacing dollar with dollar. So why pay tax on that gain? And that was the biggest part behind the capital gain inclusion rates, which what you're saying is true. There also needs to be a recognition of risk and reward.
Right. So the other thing that I thought could be a possibility in this budget, and I don't think it was, I haven't seen it, but I thought that it would make so much sense to allow for a 1031 type rollover that you have in the US, right? To say, if you're an apartment owner and you sell, even if you said you had to put that money in new construction, like not even just buy their buildings, it would have made so much sense to do rather than saying, let's convert post offices, right?
Yeah, that wasn't in there. We have there's a partial of it still there. And my tax knowledge is getting a little bit rusty, but there is a provision in the act where you can defer your recapture depreciation on business assets. But the other thing, Eric, that people haven't tied together yet on this increase in capital gains exemption, and you have our finance minister saying this is only, affecting a fraction of 1%.
Untrue.
She seems to forget that everyone is deemed to dispose of all of your assets on death.
Death, exactly.
All of your accumulated gains are triggered on death. So unless the death rate has significantly dropped in Canada since yesterday, this is going to affect a lot of the people eventually. So all of these young people that are saying, oh, great, let's tax the rich people, their inheritances just shrunk.
Yes. And I think where that 0.13 number came from, it was a number of people in the last 12 months who earned over $250,000 from a capital gain standpoint. But we have a massive disposition coming up of baby boomers. Fair enough. So that number it's just political kind of folly. So we live with political folly. Again, I haven't read the budget, but Justin had threatened that all landlords would have to declare their rent, right, to the new renter coming in, right? That opens up a box of all kinds of problems also. And we come from Ontario, so we know rent regulation, right? You guys don't. But what about Alberta I want to get back to Alberta, on the political volatility side? You flip between NDP and Conservative, which is kind of mind-boggling to me how you go from one to the other, but you do. But the end is that, the threat in Ontario, the number one threat in Ontario to apartment values is more rent control legislation. Fair enough. What do you guys think about that? First, Brian, you, then Harvey. Briefly.
Derek, we made one mistake and we'll never live it down. It'll be interesting to see what happens in the next election. Naheed Nenji, the former mayor of Calgary, is most likely going to win the NDP leadership, and it'll be a contest between him and Daniel Smith. So we'll see. It's difficult. It's difficult to predict politically.
Yes.
I will be very surprised if we elect another, and I'll be surprised and disappointed if we elect another NDP government.
Yes. So we're talking here in the section on volatility. So we got rental volatility, we got just the overall Calgary economy, we got political volatility, and then oil and gas always comes up. Well, we're not oil and gas guys in that type of seminar, but talk about how oil and gas, because that's you get painted with oil's volatile, therefore Alberta's volatile, therefore rentals are volatile. The data doesn't seem to be saying that, but talk about that for a moment.
Derek, let me talk about the NDP. An NDP in BC in Ontario is not the same in Alberta.
I tend to believe that.
That is a watered down liberal, is what that is. Yeah.
Okay, no, it's a fair comment, Harvey. The NDP may not be as kind of hardcore left wing and so on. Okay, let's quickly talk about the price of oil. I don't want to go into it. Maybe 30 seconds on the volatility of natural resources that gets tied to Alberta, that's tied to rental, even although the data doesn't say that. Harvey, you go first, then Brian.
I study the heck out of oil, and I go on this podcast and listen to 40 podcasts a year. And I encourage everybody let's consider an investment in Alberta, study the oil patch. And there's some reasons that we had some volatility in the past, and I'm not going to get into it. But, there's a lot of the big oil that their production's going down. Capital's not going into oil like it used to. There's a whole bunch of reasons that suggest that the future is going to be different than what it was in the past.
Yeah. Okay. So generally speaking, Alberta has less governance than, let's say, British Columbia and Ontario, right? So one of the stats that I find encouraging is that soft costs, meaning, you know, development charges, financing costs, and so on, in Ontario for a typical apartment building are 30+%, right? What are they in Alberta, Brian?
They're significantly less, Derek.
Yeah.
That's reality. We're less. We're probably 20% somewhere
Yes.
around there. But it varies from, you know, site to site. But certainly, I think, you know, when we look at the cost of entitlements in Calgary, I can't speak to Edmonton. I haven't built in
Sure.
Edmonton for a few years. But certainly our cost of entitlements in Calgary is less than Toronto or Vancouver by a
Right.
lot.
Right. And that cost doesn't go to bricks and mortar. I mean, you really get, in a sense, nothing for that,
You
right?
get nothing for that.
Right. And that gets passed on to the consumer, either the home buyer or the renter, and so on. Okay. All right, good.
But
So
Derek, if Matthew's list still on the program,
Yeah.
our charges are way too high.
you what?
I said if Matthew from the city is still listening, our charges are way too high.
Yes. Matthew, they're too high. Someone put that in the chat. Remember. So, but you know what? When you look at making a pro forma work, right? Land sort of is what it is. The soft costs can change. Construction costs are what they are. But you know, in the operating costs, rental taxes are a pretty big chunk of that. Typically around 30%, right? And you know, I would say to the city, like, look, you've got a parking lot in there producing no revenue for you, or very low revenue for you. Let a developer build apartment on there. You know this, Brian. The toughest years of any performance, probably the first 5 years, right? So the first 10 years. After 10 to 25 years, things are a lot better, right? So that's a lever I think cities could pull, is on the municipal taxes, right? To encourage the developers to build. What do you think of that thought? You only see it happen in pockets, and it's not consistent, so you can't plan. Winnipeg had something, Regina had something, you know, and in certain pockets for certain periods of time.
Derek, when you look at the expenses of operating a rental building, obviously we have control over very little of those expenses. We have no control over property taxes, no control over interest, no control over utilities. So the only thing that we're left with at the end of the day that we have to play with is repairs and maintenance costs.
Yeah.
So, you know, and that's such a small item on your overall cost. It's almost insignificant in terms of trying to improve the profitability or the cash flow of the property. So yeah, if they recognize that property taxes, but you know, in Calgary, our property taxes, and I don't know about other jurisdictions, but I can look at my simple little condo that I'm sitting in here today. I operate a business out of here, so my property taxes are about $12,000. The guy across the hall that lives in his condo pays about $3,000.
How much?
$3,000. I pay 12, he pays 3.
Yes, interesting. Okay, so let's talk about that. Brian, you're pulling the trigger on some new sites right now. You've got buildings under construction, right? We're going to talk about the Glenmorgan in a second, but you know, in Ontario, it's very difficult, and maybe the rest of Canada, it's very difficult to make new construction work. And the number one reaction of apartment developers has been to pause, right? But in Calgary, it's still going. What kind of, and Harvard, like you answer to, what kind of development spread yield do you need to pull the trigger? And let me define what I mean by spread. So let's take the development yield, which is NOI over total cost, the development cap rate, and the difference between that and the exit cap rate. So you have to guess at the exit cap rate, right? Let's say it's 5%, right? How much development, what does that spread have to be to get somebody to pull the trigger? I don't need to know numbers, just the spread. Harvey, your building, what do you need?
I don't look at that spread. I just look at a development margin. So
Okay.
building and my costs are X, and I divide that into the revenue, and you know, I'd like to get 25%, but I'd probably take 20, and maybe I'll end up at 17. And I just know for a fact that I spent several months looking around Toronto, and I was gonna go back there and do some stuff. And, you know, in Toronto, margins were like 12 and 13. And if there's get to 15, you're hitting it out of the park. So
right.
Obviously margins are better here. But you know, there's gonna be pressures on land and the demand is pretty significant. We're gonna get squeezed on margins here. I can
Okay,
just,
Brian, how do you make the decision? Because really, that's what we need to get people to build more apartments across Canada, right? Very few people understand the metrics of making a decision of how you pull the trigger. How do you think it through, Brian? So Harvey, you're saying you look at overall margin.
yeah,
Brian, how do you think it through?
I do the same thing, Derek. I'm
Yeah.
looking at the immediate wealth that I'm creating by building that particular project. You know, some projects I build to sell, some I build and put in our own portfolio and hold them. But if I'm looking to build something, and we've been doing this for a long time, you know, if you're not making 50% on a good project, you should be making 40-50% margin.
Margin.
Yes, margin.
Yes. Yeah. So that's hard. That's hard to make work today.
It is, but it's not impossible.
Yes. But and how do you project rents going into the future? Because everything says rents are going up.
It's difficult.
These are not easy questions. You wouldn't have come on if I...
No one has a crystal ball. You know, when I
Right.
penciled in Morgan, which we're going to look at here, I penciled that out in, I think, originally it would have been around probably early 2021. And I was using rates of just over $2 a square foot. And
Right.
you know, when we actually go and lease the thing, we're at $260, $265 a square foot, and they're increasing. Like we've over the last, you know, we finished renting our last building probably 5 months.
Rod, go to the slide of the Glenmorgan, please. Yep. Okay. So what you're saying, Brian, is that, and I think what happened, you say the rent increase that's occurred in the last couple of years has to some extent offset the construction cost increases. True or false? So how would you say? Answer? Yeah.
100% true. You know, the increase, we've seen such a increase in costs of projects that were already, you know, committed in terms of financing and stuff.
Right.
The increase in rent has saved a lot of developers' butts.
Yes, exactly. Right. And so if you believe what Jeremy said, right, and what Matthew said, which sound believable, it sounds like rent increases are going to continue.
Yes.
And so therefore, if the rent increases continue, let me ask you a theoretical question. Let's go back to 2017 or 2000, where you pulled the trigger, where you made the decision on the Glenmorgan, right?
It was
are those right? So are those returns back again? I know the costs are up and everything else, but the rent is up also. So are you almost in that same profitability standpoint when you consider the higher rent?
A little bit less. But it's
a little bit less.
Costs have stabilized.
Yes.
We've seen costs, probably there was a 25% increase across the board. If you look at individual cost codes, like mechanical was up 40%. But overall, probably up 25%. Interest, interest, construction, during the construction period for this project, interest doubled.
Yes.
Literally doubled.
Easy doubled, yes.
Yeah, so hopefully we'll see those costs. And that's a significant cost item on any budget. So we should see those come down.
Rent increases save the day.
Yes.
Harvey, what's your comment on that?
Let me go off on a bit of a tangent here. So, you know, I've got the advantage of brokering apartments for 30 years. And, you know, and we had some good years, you know, 2007 and 8 and 14, 15, 16. We'd put up an apartment for sale and we'd get 9 bids from all over Canada.
Yeah.
And, you know, there was buildings sell at 4 caps, 4.1, 4.2. And so then we went into a space where the demand fell off and we weren't getting very many bids from across Canada and cap rates basically went up. So today, all that demand's coming back, like Quebecers, Ontario guys, BC private guys.
Yes.
All this interest, they come in here, they start looking around. So I predict that we're going to be in a more favorable market and we're going to see cap rate depression.
Compression. Yes. Yeah. So Harvey, what you're saying is because of the favorable geographic population metrics, you think that there could be cap rate compression?
Well, I think just right now, we can see that all kinds of guys all over Canada, 2 years ago, they had zero interest in Alberta. Now they're coming here and they're excited and they see
Yes.
everything else. So it's gonna be more and more competitive, and I think we're gonna see cap rate compression.
Yep. And I think that if you look at Alberta, I would call Alberta a red state. Okay. Red meaning it, people in Alberta act like people from the Midwest and from sort of the central, the heartland of America. The overall culture there is more pro-friendly and pro-business. And hopefully your left-wing governments aren't the same as the left-wing governments that we've seen in British Columbia and Ontario. But overall, that's the reason we do these seminars and these webinars, because we think that Alberta seems to be different than the rest of the country, and it acts like Indiana, it acts like Ohio, it acts like Kentucky, like that, in terms of a place where business is welcome. And I notice even just, when Rod and I are looking for speakers from the municipality, right? Just the readiness of the city of Calgary, the city of Edmonton, and so on, of people to come on and talk about what they do just feels higher and more positive than finding those counterparts in other provinces. Okay. And other cities. We want to thank you for joining us. We really think that Alberta is a red state. And Rod, put up the next slide, okay? If you're interested in acquiring properties, Harvey's the local guy on the ground here. Carol Ennis leads our brokerage team here. And we appreciate all of you joining us. Thank you very much, guys. Brian, Harvey.
Thank you.
Cheers. Bye.